We have jobs data today, big moves we're seeing in interest rates. Let's tell you why that's happening. First, we break up a week where we got JOLTS data that was weak, ADP data that was weak, jobless claims that were a little higher than expected. The ISM employment was weaker than expected, 46.5, below that key 50 level. Then all weak numbers in a row in terms of the labor market. Now today we get jobs, 22,000 non-farm payrolls. And not only that, an unemployment rate that went to 4.3%. Now, why is that important? That's one part of the continuing talk about a weakening labor market. But if you're looking at interest rates, there was a two-headed monster here. Wages actually went up 0.3 month over month, but year over year from 3.9% to 3.7%. So even less now focus for the Fed on inflation problems and more focusing on the labor market. Now, within that report on non-farm payrolls, we had manufacturing down 12,000 jobs, healthcare up 31,000 jobs. Here's the one thing that I think is key in this trend. 15,000 loss of government jobs. So since January, the government jobs are now down 97,000. Remember, during the Biden administration, 41,000 a month they averaged in the final year of the Biden administration. Now down 97,000 since January. Incredible switch there in hiring. Now, in terms of revisions, that was key. June down 27, but interesting, July up 6,000 from 73 to 79,000. So when you look at it, other positive things, labor force participation ticked from 62.2 to 62.3. That means more people in the labor market. So what that means is lower interest rates, more chances for either a 50 basis point move in September or more 25 basis point moves over the next several months. Now they're building in 3 moves, and something we mentioned earlier in the week, that 50 basis point chance of a cut in September now gaining momentum. Not enough to facilitate a move, but still a number that we're going to be watching. CPI, PPI next week will be key.